Hey everyone, and welcome back to Am I Catching a Falling Knife? The podcast where we dig deep into stocks taking a tumble to see if there's a rebound in sight or if we should steer clear. I'm your host, Dave, and today we're dissecting a true heavyweight of the healthcare sector, United Health Group, ticker symbol UNH. This healthcare giant has seen its stock drop quite a lot in the last few days, making it look a lot like a prime candidate for our falling knife segment. So let's find out if this is an opportunity or a warning sign. So what's the story here with UNH? Well, the market is buzzing about two big things. The Department of Justice is scrutinizing their Medicare Advantage billing practices, and rising medical costs are hitting their profitability. This double whammy has really put a damper on the stock, driving that significant decline we've seen, especially with their Q2 earnings report just around the corner. Now let's talk about United Health itself. This isn't some small player. They're a diversified healthcare and well-being powerhouse, the largest healthcare company by revenue in the US and Canada. They make their money from a whole host of sources: premiums from risk-based products, fees for services, sales of healthcare products, and even investments. The company is neatly split into two primary divisions: United Healthcare, which is their health benefits arm and brings in a hefty 57% of their total revenue, and Optum, which handles everything from pharmacy care services through Optum Rx, health savings accounts and provider services via Optum Health, to payment processing and consulting with Optum Insight. They serve over 147 million customers worldwide, so we're talking about a massive operation here. Now let's get into the numbers. So how did we get to that estimated earnings impact we're seeing from this narrative? Let's break it down. Our market narrative, with the DOJ scrutiny and those rising medical costs, primarily impacts the United Healthcare segment, which, remember, accounts for 57% of United Health Group's total revenue. First, regarding that Department of Justice scrutiny on Medicare Advantage billing practices, we're estimating that Medicare Advantage contributes approximately 35% of United Healthcare's revenue. If you do the quick math on that, it translates to roughly 20% of UNH's total revenue. We've put a conservative estimate for potential revenue adjustments or increased compliance costs in this specific area at a 0.75% impact on that Medicare Advantage revenue stream. This equates to a 0.75% multiplied by that 20% of total revenue, which comes out to a 0.15% reduction in UNH's total revenue that would otherwise flow directly to profit. Second, let's talk about those rising medical costs. This directly impacts what's known as the medical loss ratio, or MLR, of the United Healthcare segment. We're assuming a 125 basis point, or 1.25%, increase in the MLR for the United Healthcare segment. This means they're paying out more in claims relative to the premiums they collect. Since United Healthcare makes up 57% of total revenue, this MLR increase translates to a 1.25% multiplied by 57%, which is a 0.7125% reduction in UNH's total revenue that would otherwise flow to profit. Combining these two impacts, the total estimated reduction in profitability, expressed as a percentage of total revenue, is 0.15% from the DOJ scrutiny, plus 0.7125% from the rising medical costs, which sums up to 0.8625% of total UNH revenue. Now, to translate this revenue equivalent profit reduction into an earnings per share percentage impact, we use a representative net profit margin for UNH, which we're estimating at 5.5%. The percentage impact on net earnings is calculated by dividing that total revenue equivalent profit impact by the net profit margin. So 0.8625% divided by 5.5%, which gives us approximately 0.1568, or about 15.68%. Therefore, the final estimated negative impact on quarterly earnings is roughly 16%. Now, it's important to understand this isn't an exact science. Our confidence interval for this impact is between a -20% and -12%, reflecting the inherent uncertainty in precisely quantifying the financial hit from ongoing regulatory scrutiny and the exact magnitude of rising medical costs within a single quarter. While the direction is clearly negative, the precise percentage can certainly vary. So, where does that leave us on valuation? To get a fair value, I ran a discounted cash flow model. For our base case, I used assumptions like a modest negative 0.29% 5-year growth rate, a discount rate of 9.5%, that's essentially our required rate of return, and a terminal growth rate of 2.5%, representing their long-term growth. This gave us a base case fair value of about $310.38 per share. Now here's where the narrative comes in. Applying our narrative's estimated 16% earnings impact to that model, our narrative adjusted fair value drops significantly to around $248.31. Given that adjusted value, my custom buy levels, where I'd start looking to dip my toe in this falling knife, are around 250, then if it keeps dropping, 190, and finally 175. These are the points where, in my view, the potential reward might start outweighing the risk, assuming the narrative plays out as we've discussed and the market overreacts. So, to wrap things up on UNH, remember, what we've discussed here is for informational and entertainment purposes only. This is not financial advice, and you should always do your own thorough research and consult with a financial professional before making any investment decisions. Markets are complex, and the information we discuss is to help you think through these situations. Thanks for tuning in to Am I Catching a Falling Knife? I'm Dave, and I'll catch you next time.